Everyone says the US dollar is on the brink of collapse, yet central banks are buying it faster than ever before. If the world truly hates the American financial system, why is every alternative failing to take its place? Today, we explore the dollar trap, the global economic hostage situation that nobody can escape. For decades, predictions of the dollar's demise have echoed across financial headlines. From oil shocks to financial crises, from wars to political turmoil, the obituary of the American currency has been written again and again. And yet, here we are. The dollar remains the backbone of global trade, the anchor of central bank reserves, and the ultimate safe haven in times of panic. The paradox is striking. The more unstable the world becomes, the stronger the dollar often appears. To understand this contradiction, we need to go back to 1944, to a quiet town in New Hampshire. At the Bretton Woods Conference, representatives from 44 nations gathered to design a new global financial order after the devastation of World War II. The agreement they forged made the US dollar the world's reserve currency, convertible into gold at $35 an ounce. This system, later known as the Bretton Woods system, established the dollar as the foundation of global finance. Even after President Richard Nixon ended the dollar's convertibility into gold in 1971, an event often called the Nixon shock, the dollar did not collapse. Instead, it evolved. The Petrodollar system emerged, with oil priced globally in dollars. Countries that needed energy had to hold dollars. Trade was invoiced in dollars. Debt was issued in dollars. The network effect deepened. Today, more than half of global foreign exchange reserves are held in dollars. International commodities from oil to wheat are priced in dollars. Corporations borrow in dollars, even outside the United States. The U.S. Treasury market remains the largest and most liquid bond market on Earth. When investors panic, they don't flee the dollar, they run toward it. But why? The answer lies not only in American power, but in structural dependence. The dollar is not simply a currency, it is infrastructure. Global banks clear transactions through dollar-based systems. International contracts are written in dollars. Cross-border payments rely on dollar liquidity. The financial plumbing of the world runs through New York. Consider what happens during a crisis. In 2008, when the global financial system nearly imploded, it wasn't euros or yuan that corporations desperately sought. They needed dollars. The U.S. Federal Reserve opened emergency swap lines with other central banks, effectively acting as the world's lender of last resort. Again, in 2020, as the pandemic froze global commerce, dollar shortages triggered panic. And again, the Federal Reserve provided liquidity to stabilize markets. The irony is profound. Countries that criticize U.S. monetary policy still depend on it in moments of distress. This is the dollar trap. Nations may wish to reduce their exposure to American influence. They may resent sanctions that weaponize access to dollar clearing systems. They may question U.S. fiscal discipline as national debt climbs into the tens of trillions. Yet, exiting the system is extraordinarily difficult, because leaving the dollar means rebuilding an entire financial ecosystem from scratch: deep capital markets, trusted legal frameworks, transparent institutions, and global confidence. Let's examine the alternatives. The euro was once seen as the most credible challenger. Launched in 1999, it represented a unified European economy large enough to rival the United States. The European Central Bank offered stability and credibility. For a time, the euro's share of global reserves grew, but the European sovereign debt crisis exposed structural weaknesses. Countries like Greece, Italy, and Spain faced massive imbalances without a centralized fiscal authority to back them up. Investors began to question the cohesion of the eurozone itself. The euro survived, but its momentum as a dollar replacement faded. Then there is China's currency, the renminbi. As the world's second-largest economy and the largest trading nation, China seems positioned to challenge dollar dominance. Beijing has promoted cross-border trade settlements in renminbi and established alternative payment systems. It has even launched a digital currency. Yet capital controls remain tight. The currency is not fully convertible. Legal transparency is limited compared to Western markets, and global investors hesitate to trust a system where policy decisions can shift abruptly. Russia has attempted to move energy trade away from the dollar, particularly after sanctions intensified. But without a deep and trusted financial market to support it, such efforts remain limited. Even oil exporters who accept non-dollar payments often convert proceeds back into dollars for investment. Some argue that gold could reclaim its historic role. Central banks have indeed increased gold purchases in recent years. Gold carries no counterparty risk and cannot be printed, but gold is not practical for modern global trade. It does not provide liquidity at scale. It cannot support the trillions of dollars in daily financial transactions that digital markets demand. Cryptocurrencies, led by Bitcoin, have been hailed as decentralized alternatives to state-backed money. They operate outside traditional banking systems and are resistant to censorship. Yet volatility remains extreme, regulatory frameworks are inconsistent, and cryptocurrencies lack the stability required for large-scale reserve management. Central banks cannot anchor their economies to assets that can lose 20% of their value in a week. So the world finds itself in a bind. The United States benefits enormously from this arrangement. The demand for dollars allows the U.S. government to borrow at relatively low interest rates. It enables America to run persistent trade deficits without triggering immediate currency collapse. It gives Washington immense geopolitical leverage through sanctions and financial access controls. But this privilege also creates responsibility and risk. If confidence in U.S. institutions were to erode significantly, the repercussions would be global. The system's strength depends not only on economic size, but on trust. Trust in the rule of law, in the independence of the Federal Reserve, in the enforceability of contracts, and in political stability. Critics argue that weaponizing the dollar through sanctions accelerates efforts to build alternatives. When nations are cut off from dollar clearing systems, they search for workarounds. Parallel payment networks emerge. Bilateral trade agreements in local currencies expand. These shifts may not overthrow the dollar overnight, but they gradually chip away at its dominance. Yet even these efforts face the same dilemma: scale. Financial systems thrive on network effects. The more participants use a currency, the more valuable and liquid it becomes. Breaking that cycle requires a coordinated global shift, an extraordinarily complex undertaking. No single country, not even China, can replace the dollar unilaterally. It would require a coalition of major economies willing to risk instability during transition. And here lies the heart of the paradox. Many nations want a multipolar financial world. Few are willing to endure the turbulence required to build it. In moments of crisis, ideology gives way to pragmatism. Investors seek safety, corporations seek liquidity, central banks seek stability, and the dollar, despite its flaws, still provides all three. The dollar trap is not about love or hate. It is about inertia and interdependence. The global economy has been constructed around a single monetary axis for nearly 80 years. Supply chains, debt markets, and sovereign reserves are entangled within it. Escaping would mean rewriting the operating system of global finance. Could the dollar eventually lose its dominance? History suggests no currency reigns forever. The British pound once held the world's reserve status, supported by the vast reach of the British Empire. But economic power shifted, wars drained resources, the center of gravity moved westward. Transitions, however, unfold over decades, not headlines. If a new reserve system emerges, it may not be a single currency. It could be a fragmented landscape where regional powers settle trade in multiple units. It might involve digital currencies issued by central banks. Or perhaps a basket of currencies will dilute dependence on any one nation. But none of these scenarios eliminate the central challenge. Trust cannot be manufactured overnight. For now, the dollar's dominance persists, not because it is perfect, but because it is deeply embedded. Alternatives exist in theory, but they lack the depth, liquidity, and institutional confidence required to fully replace it. So when headlines proclaim the imminent collapse of the US dollar, remember the paradox. Central banks are not preparing for its funeral, they are still buying its bonds. Nations may criticize American policy, yet they store their wealth in American assets. The world may desire change, but it remains anchored to the system it questions. This is the dollar trap, a global economic hostage situation without a clear escape route. The question is not whether dissatisfaction exists. It clearly does. The real question is whether any nation or coalition of nations can build something stronger before confidence in the current system truly falters. Until that day comes, the dollar remains both a source of power and a symbol of dependency, a currency many claim to distrust, yet none can fully abandon.